the VIX just plunged 6.44%, completely erasing the geopolitical risk premium that had markets on edge just days ago. Welcome to the D-Risk Weekly Global Markets Brief. It's Saturday, August 1st, 2026. Our theme this week is the vacuum of fear. The biggest dislocation in macro markets right now is how quickly defensive postures were dismantled without any actual macroeconomic resolution, driven entirely by a lack of new escalations. When no news is treated as good news, capital rushes in to fill the void, ignoring the structural risks that remain unresolved beneath the surface. Alex, let's start with the international tape. Asia and Europe.
Thanks, Sarah. In Asia, the technical structures are flashing warning signs despite some positive surface action. The Nikkei drifted lower by 0.39% to 64,362. It is currently wedged between its 200-day moving average at 56,974 and an artificially elevated 50-day moving average at 67,123, struggling to find a stable baseline after the recent semiconductor rout. Meanwhile, the Hang Seng posted a weekly gain of 3.69% to close at 25,884. However, it remains trapped under a structural death cross, with the 50-day moving average at 24,951 sitting below the 200 at 25,734. This implies the Chinese tech rally is technically unconfirmed and driven by opportunistic short covering rather than a genuine fundamental recovery. Europe is telling a completely different story. Germany's DAX rallied 2.11% to 25,629, and the UK's FTSE 100 rallied 1.23% to 11,868. Both indices are riding pristine golden cross structures. Capital is flowing smoothly into European value and defensive sectors because they offer a reliable safe haven from global semiconductor volatility. Sarah, back to you.
That divergence between Europe's clean value rally and Asia's technically unconfirmed tech bounce is the story right now. If capital is actively seeking refuge from semiconductor volatility overseas, how is Wall Street handling the pressure of this rotation? Alex, break down the U.S. and cross-asset signals.
Wall Street is shaking off the midweek panic, Sarah. Looking at U.S. futures, the NASDAQ 100 edged up 0.59% to 28,404, and the S&P 500 edged up 0.63% to 7,519. The Dow Jones drifted 0.49% to 52,635. Blockbuster tech earnings validated massive AI infrastructure spending, unwinding the geopolitical anxiety that temporarily dragged equities down. In the bond market, we are flying blind on the 2-year Treasury this week, so we will focus entirely on the long end. The 10-year yield drifted higher by 0.21% to 4.68%, confirming that restrictive monetary conditions remain intact. This elevated yield environment failed to support the U.S. dollar index, which closed lower by 1.65% to 99.80. While it technically maintains a golden cross, the price has broken below its 50-day moving average of 100.42, exposing near-term weakness. In commodities, the lack of fresh geopolitical shocks forced a massive unwinding of the supply risk premium. Crude oil closed lower by 5.20% to 85, despite sitting above its 50-day moving average of 82 and 200-day of 76. Gold drifted lower by 0.45% to 4,049, confirming its active death cross as the 50-day moving average at 4,201 crossed below the 200-day at 4,479. Finally, the VIX plunged 6.44% to 15.99, reflecting a sharp deterioration in defensive positioning as fear leaves the market. Sarah, back to you.
Thanks, Alex. The rapid unwinding of defensive trades across commodities and volatility proves that the vacuum of fear is actively dictating capital flows. When the VIX plunges 6.44% simply because the news cycle went quiet, you know the vacuum of fear is driving the market's risk-on reflex. Looking ahead, all eyes are on next week's non-farm payrolls report. If the labor data comes in hot, expect the U.S. dollar index to aggressively reclaim that 100.42 level we saw on its 50-day moving average, which would immediately pressure gold and test the resilience of this equity rebound. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in, and catch you in the next episode.